looking at revenue and costs as part of the finance section of the course. So a few definitions that we need to know. Revenue is the income from selling goods and services, also called turnover. Costs, this the money used to create the goods and services. Profit is revenue minus costs. It's the reward for the entrepreneur, the owners. So if we're looking at some of the calculations and a few more, breaking down costs into a little bit more detail. Fixed costs, these are costs that don't vary with output. The business has to pay them whether they produce 100 units, 1,000 units or 0 units. So rent, business rates, that's like council tax for businesses, salaries as well. Variable costs, though, these are costs that do vary with output. So your materials, your raw materials, your wages. Total costs would be total fixed costs, add your total variable costs. Variable costs usually get stated in the case study as per unit, so then you have to times it by however many products they're making. Fixed costs are fixed, they stay the same, so it'll just state a number. And total revenue is the price times however many they're selling. And profit, as I said before, is revenue minus the total cost. So here's a past paper question, nice multiple choice question. Which are examples of fixed costs paid by a coffee shop? So think, would they have to pay this if they sold nothing, if they made no coffees? So monthly payment for the coffee making machine, yeah, if they're leasing that, they would have to pay that even if they made no coffee. Payment of business rates on premises, I've already said that that is a fixed cost. Value added tax paid to the government. Now this depends upon how much they sell, so that's going to be variable. Electricity bill to power the coffee making machines. Presumably the coffee making machine is going to be on more if you're making coffee, so that is going to change depending on how many coffees that you make. The cost of the ingredients, that's raw materials, so that's variable. Rent. The landlady, the landlord does not care if you've made coffee or you haven't made coffee, they want their rent that month. So those three are going to be fixed costs. Here is a nice case study about Ali, who has a juice bar and thinking of making smoothies, and you'd have to use yogurt to the juice. So question, what is meant by the term variable costs? So these are costs that vary with output. Apart from yogurt, give one other example of a variable cost that Ali's business will have to pay. So, I mean, they say yogurt, so you could just say the fruit, and they need that for the smoothies. Wages as well, so hourly, the sales staff, the hourly pay of the people making the smoothies. I suppose if he knows he's not going to be making any smoothies that day, he doesn't call people into work. And that's that section.